So welcome to the Data Explorer's Market Update with me, Will Duff Gordon. So today I'm talking about China, and don't worry, I'm not going to harp on the same old tired investment theme of short selling in China. But what I've discovered is that the data is showing that there's very much a tale of two cities here. There are those hedge funds in Hong Kong who are actually covering their short sales in the China shares listed in Hong Kong, the H shares. Then there are those investors in New York who are actually increasing their short sales in the China companies listed on the NASDAQ. And I've looked at about 300 of them, so there's no particular bias to any sort of companies that could be suffering from dodgy valuations. So generally speaking, people are more sort of skeptical about China's boom if you're in New York than you are in Hong Kong. So let's sort of zoom in, because this is really sort of Anthony Bolton versus Hugh Hendry. You know, there's plenty of fund managers, Jim Chanos bearish versus Anthony Bolton being positive. So if we look at, say, a company like Ning, we've already covered it, but it is a sportswear manufacturer. Short interest has risen since I covered that last week, and the Lex has covered it. They are the kind of the Nike of China. 10% of their shares are short. And I've added another one to that, which is now called the Deere Consumer Brands. It makes electrical goods, blenders, kitchen appliances for the Chinese market. That has a staggering 20% of its shares short, and it's listed in America. So there's a theme here, which is possibly that the kind of the enfranchised Chinese consumer, if they have the disposable income, is spending money more and more towards maybe international brands and going away from kind of the leanings, the local brands, which is quite an interesting theme. So it's not just about the Chinese consumer buying anything aimed at them, but they're maybe moving towards international brands. But that's an unproven thing, but that's just something that the data is leaning towards. Now, Hugh Hendry is basically saying that the kind of combination of slowing down exports, house prices coming down, is going to kind of really hurt the Chinese consumer. And there's possibly sort of an elite building in China. Very interesting stat I read over the weekend was that in America in 2007, 1% of the high earners, so the earners in the top 1%, earned 18% of the country's wealth. If the same thing is happening in China, then there isn't really this mass consumer coming in. It's very much an elite, so the wealth is not trickling down, is Hugh Hendry's point, which is going to lead to big problems and a collapse. Often people talk about real estate. That's the kind of the boom. You know, you can go around Hugh Hendry's video, very entertaining. He's looking at all of these skyscrapers in China and saying, look at that amazing building there. Probably cost $500 million to build. Look at it, it's completely empty. No surprise that 3 of the top 10 H shares in Hong Kong that are most shorted are the property firms Agile Properties, Sui On Land, and Sino Ocean. Interestingly, though, while quite shorted, it's actually coming down recently. So people think that maybe the local people in Hong Kong are very aware of how much the Chinese government can intervene to kind of prevent a bubble, and therefore they're nervous about shorting these real estate companies. If I nip over to a different type of company, which is Chongqing Iron Steel. Chongqing is a city in the inland China, which is sort of trying to be what Chicago was to America about 100 years ago, i.e. a big inland city profiting from the industrial expansion, even though it's a long way away from the coast. But here's the problem. Because it's a long way away from the coast, most of the demand for the expansion is being driven by domestic people. If there's a slowdown in China, lack of exports, everything slows down, the domestic people are going to run out of money. So there's rising short interest in this particular company. It's also a steel and iron manufacturing company, and steel prices are forecast to go up a hell of a lot. So no surprise to see that go from 2% to 5% short. So finally, let's take a look at the ETFs. So finally, I'm going to say that the A shares ETF, coming up by iShares, which tracks the 50 biggest companies in China, that's at 6.5% short, which is a sort of 6-month high. So people are sort of buying protection on China's large cap companies. And finally, there's an ETF that just tracks Chinese financials, and there's a little bit of short selling in that one too. That's all for now. It's quite a sort of detailed and intense report. I apologize for my seriousness today, but if you'd like to read the proper structured report, it is at dataexplorers.com/news.